Have you ever had that feeling that the market is just, I don't know, rigged against you? You see the perfect setup. You place your trade, you're feeling good, and then, bam, you get stopped out by just a few pips right before the price absolutely rockets in the direction you predicted. Well, let me tell you, it's not in your head, and it's not just bad luck. It's the game. And today we're going to pull back the curtain on the playbook of the financial 1% and see exactly how they profit from the very predictable mistakes of everyone else.
And this right here, this quote gets to the absolute heart of it. See, professional trading isn't about gambling. It's not about guessing which way the market's going to go. It's a hunt. It's a systematic process of understanding what actually fuels the market, knowing exactly where that fuel is located, and then positioning yourself so you can ride their waves instead of getting totally wiped out by them.
So why is it that so many people who get into trading fail? I mean, it's not because they aren't smart or don't want it badly enough. The real problem is that most people are taught to play a game without ever being told the real rules. It's like they're showing up to a 3D chess match and trying to play checkers. The game is just completely different from what they think it is.
And this is where you see the night and day difference. The retail mindset, it's all about emotion. It's reactive. It's chasing that get-rich-quick dream, right? They buy breakouts, they sell breakdowns. But institutional logic is the total opposite. It's cold, it's calculated, it's a process. They are not reacting to the market, they are the ones creating the market moves. They know precisely where retail traders have put their stop losses and their entry orders, and they use those orders as fuel to send the price screaming in the other direction.
Okay, this brings us to the most critical concept of all, the one idea that underpins the entire institutional strategy. And once you see it, you can't unsee it. It's not just some technical term, it's the very gasoline that makes the market engine run. Let's talk about liquidity.
So what does that even mean, liquidity? Well, think about it. If a huge bank wants to fill a massive sell order, we're talking hundreds of millions of dollars, they can't just click a button. They need an equal amount of people buying on the other side. So where do they find them? They find them in these predictable pools of orders. All the stop losses from sellers and all the breakout entry orders from buyers, all clustered together in the same obvious places.
And you have to start thinking about it like this. Seriously, price isn't just randomly bouncing around your screen. It is being deliberately pulled, almost magnetically, toward these zones of high liquidity, those obvious highs and lows on your chart. Why? Because that's where the big institutions can get their business done. These pools of money are magnets, and they are actively pulling the price right to them.
Okay, so we get the why. They hunt for liquidity. But how? How do they actually pull it off? This isn't chaos, you know? It's a repeatable, three-act play that you can see happening over and over again on every single time frame. So let's break down that playbook, step by step.
Here it is, the blueprint. First up, the hunt. They go out and grab that liquidity. Second, the confirmation. They patiently wait for a clear signal that the market's direction is actually shifted. And third, the ambush. They find a high-precision spot to re-enter if they miss that first move. It's a sequence. Hunt, confirm, and then execute.
This is the hunt. You know that feeling, right? That incredibly frustrating moment where the price just wicks above an old high, takes out your stop loss, and then immediately reverses? That was an accident. No way. That was a textbook liquidity sweep. It's an engineered move specifically designed to trigger all those resting orders, filling the massive positions the institutions need to start the real move.
Now, after the hunt, you need confirmation. A professional isn't fooled by a simple wick. A wick is just a probe, a quick little test to the waters. They wait for a candle to close decisively past the previous market structure. A close? Well, a close is commitment. It signals that a huge amount of capital has entered the market and is now holding the line. This is the market showing its true hand.
But hey, what if you miss that initial explosive move? Does that mean the trade is gone forever? Not at all. The pros, they don't chase the price. Ever. They are patient. They let the market come back to them. And there are specific tools they use to identify these high-probability ambush points.
The most precise tool they've got is something called an order block. Think of it like a footprint in the sand. It's the literal price range of the very move that swept the liquidity. Since this is where they first got into their massive position, you can bet they're very likely to defend that level if price comes back to test it, making it a super powerful entry point.
Sometimes a move is so strong, so aggressive, it leaves behind an imbalance in the market, a sort of vacuum or void. The market, it hates a vacuum. It almost always seeks to rebalance itself by retracing back into this fair value gap. And that offers another fantastic high probability zone to rejoin the new trend.
We can talk about fancy entries and chart patterns all day long, but honestly, none of it matters. Absolutely none of it, without this next part. This is the bedrock of professional trading. This is the one thing that truly separates the 1% who make it from the 99% who don't. It's not about being right, it's about how you manage being wrong.
The single most important rule in the entire professional playbook is this: you risk only 1%. That's it.
So why is that one little number so incredibly powerful? Well, first, the math is simple. If you only risk 1% per trade, you have to lose 100 times in a row to blow your account. Just think about that, 100 straight losses. But the psychological part is even more important. It detaches your ego from any single trade. It removes that destructive fear and greed, and it turns trading from an emotional roller coaster into a calm, repeatable business operation. Your number one job is survival.
And that right there, that's the whole game. It is not about hitting one life-changing home run. The market isn't going anywhere. There will always be another setup tomorrow and the next day. The professional's number one goal is capital preservation. They just live to trade another day because they know their edge will play out over the long run.
So, when you start to put all these pieces together, the hunt for liquidity, the patient execution of a playbook, and ironclad risk management, you start to see the market in a completely new light. It stops being this chaotic, random casino, and it starts becoming a system that you can actually navigate with a clear process.
And you really have to make a choice. Is the market your casino, where you just pull the lever and hope for the best? Or is it a system, a complex machine with rules that can be understood and a process that can be executed? The 1%, they treat it as a system. They are not gamblers. They are executors of a high-probability plan.
You know, the ultimate secret isn't some magic indicator you can buy online. The secret, the real glitch in the matrix, is the skill itself. When you truly understand why the charts are moving the way they are, when you can read the flow of liquidity, you gain a permanent edge.
So, I'll just leave you with this one question to think about. The market is always going to be a game between those who know the rules and those who don't. The only choice you have to make is which side you're going to be on.